if you're looking to invest in real estate like the pros, maybe commercial real estate is what best might be a good option for you. Today I have with me Tom Wilson. Welcome, Tom.
Thank you, Tom. Nice to be here.
Yeah, great to have you in. And I hear so much about you here in the Bay Area. You've made quite a name for yourself with all the commercial real estate investing you've done. You started out as an engineer, but eventually got into real estate investing. You've invested in over 4,000 units and 400 million in real estate investments. That is quite the undertaking.
We've been busy.
Yeah.
Fortunately, I have a wonderful team that does most of the work.
Yeah.
I get to take the glory.
All right. Good. So maybe just share a little bit about yourself, if you could, and what it is that you really enjoy about real estate. Why might people even consider commercial real estate, I guess, is where we eventually want to go with this.
Well, I love hearing about people's crossroads and what changed their lives. Certainly one for me was when I arrived in Silicon Valley in 1969 at the father of the semiconductor industry, Fairchild. I rented my first house. The landlord lived next door and he owned half the street. So that was a big aha moment for me. I didn't forget that.
Yeah.
And even though most people at that time said I wouldn't invest in a house in California, prices had gone up so much in the 50s and 60s, I couldn't imagine they go up anymore.
Yeah.
That's true. That's a true story.
And they just keep going.
But it sounded like a good idea to me. So so as soon as I could save up some money for my engineering job, my bride was a nurse, and we fortunately could live on one salary. So we started saving money and buying houses in Silicon Valley. Then after 30 years and 2 startup companies that did not hit a home run, I realized I was making more money while I was sleeping from my real estate than I was in my day job and my stock options. But by then, and 30 years later, 99, we realized that the income was not very good anymore. Prices had gone up too much, and as prices go up with any kind of real estate, the rents never appreciate as much.
Yeah.
So then you get this reduced income per invested dollar. So I studied the country and talked to everybody I could find who was a successful real estate investor. And to my surprise, they were all mostly investing out of state at that point in time. So I looked at all the different cities that they recommended and did a lot of research on my own and traveled to some and picked Texas and Dallas.
Okay.
And within 6 months, I started selling properties in California, buying them in Dallas, Fort Worth. And within 6 months, I'd replaced my VP salary on my last startup company. So it wasn't very long after that, I started buying multifams and did some condo conversions, but also had a lot of houses. And then I had a lot of folks in Silicon Valley and at the real estate clubs that said, Tom, what you're doing there makes sense to me, but I don't have the knowledge and I don't have the time. Could I buy some product from you? So after I heard that about 6 times, I thought it was time to sketch out a little business plan and hang out a shingle on the web, and it took off.
Wow.
So
wow. And now today you have just over 300 individual investors, I think you shared.
Well, we have a client base of over 6,000. We have over 300 who've invested with us in more than one syndication deal.
Okay. Wow.
So we have a lot more than that have bought houses. We provided about 650 houses to investors, those houses in Dallas, mostly Dallas, to investors throughout the country, but mostly in California.
Okay.
So what happened was, a few years ago, 3 or 4 years ago, it just got to be too difficult to find quality houses and quality metros that gave the same cash flow that they did. And so we went back to the syndication model and switched to mostly commercial. Of course, commercial means based on commerce. So multifam is part of commercial properties too, although many people who aren't familiar with the space tend to think that It's just multifam.
Mm-hmm.
I like multifam. I've owned 9 of them, still own 3. But nowadays, the non-multifam commercial properties are giving 2 to 2.5% higher returns than multifam.
Okay.
Just so many people, if they've owned rental houses, I think what happens is the perception is that if they know how to do that, then they know how to do a multifam. And as it turns out, a multifam is really a lot more difficult, a lot more moving parts than most people realize. Plus, since the crash, money has tightened up. Used to be anybody could get a loan before, even for commercial before the crash. Now, unless you're already invested in, as you know, in the commercial arena, multifam, if you don't own property already, very difficult to get a loan, mm-hmm. especially if you're out of state or one of any size. So the way to take advantage of being in commercial real estate that normally only wealthy investors and institutions can invest in is to ride on the coattails of a syndicator. Mm-hmm. Because the syndicator can have access to deals. You need a lot of deal flow in order to get those nuggets out the bottom.
Yeah.
We have collectively, our team we get over 300 deals a day sent to us, not going on LoopNet or CoStar or something, sent to us.
Wow.
And of course, most of those are instant reject, but mm-hmm. you need mm-hmm. that kind of deal flow. And you need someone with expertise that knows how to negotiate the contract, who knows how to can qualify for the loan, who can do the due diligence, who can do the underwriting, and can manage. Now, you don't have to manage, but I think it's an advantage if part of your team is also in the management business, because for a syndicator, most of the return for most syndicators is upon exit. So that means it's very important, and the investors want you to be engaged to make sure that that product is maximized in its returns.
Okay.
So that's a big incentive for the syndicator to work hard and to make sure you've got a great management team on board, mm-hmm. so that you can maximize the returns.
So in a minute we'll go to the process. If someone is listening and they would like to get involved with commercial real estate and some sort of a syndication, we'll talk about that. But first, could you just describe or share a little bit about your radio show? You've got a weekly radio show.
Mm-hmm. We've been doing about 5.5 years, mm-hmm. Radio show on real estate investing. It's on broadcast on KDOW 1220 AM, mm-hmm. The leading business radio station in the Bay Area. Same one that the Real Estate Guys radio is broadcast on, which is the mm-hmm. leading broadcast mm-hmm. in the world. And it's we've had just very good response from that. So we bring on all kinds of guests now that are well known in California and nationally, like Chief Economist of Fannie Mae, Dr. Doug Duncan was just on, Robert Kiyosaki, Kim Kiyosaki, mm-hmm. Robert Campbell, Bruce Norris, many just a really expert guests. And boy, what I'm sure as you feel the same as I do, it's just great to be able to have guests who are experts in their field, and we get to ask our favorite questions, right? And find out, and then share that with all of our friends and client base out there.
Yeah, and the value in learning from other people, what other people have done, what other people are doing. Even you and I being in the profession, where anything that we can learn from each other and collaborate, team up, work together, it just makes so much more sense, and it reduces the risks, makes for better opportunities. And I think that's why I mean, your radio show has got to be just a tremendous help and support for people who are just starting out too.
I'm amazed when I speak at audiences, what the percentage who raise their hands if I ask if you ever heard the radio show. Mm-hmm. Audience will typically 30% have heard it, which is just boggles my mind. But you know, I think I was born extremely curious, mm-hmm. and I think everyone needs to figure out how they learn best. Mm-hmm. Of course, we all learn from multiple ways, but there's usually one way that I think each individual learns the best and the easiest. And I think for me, it's always been asking people who are experts and more knowledgeable than I am my questions. And it's very efficient that way, because you get to know what you know that you don't know, right?
Yeah, right.
And you whereas if you're taking a course, you often go through a lot of things that maybe you already know or don't need in order to get to those nuggets. Where you ask someone who's an expert.
Pretty direct this way.
Yeah. So that's always been my favorite way, and so this is a perfect fit for me, is to have guests on and get to ask them, my favorite questions about things that I want to know. And I proudly tell my team and anyone that even with all of the experience that I've got, I can't remember the last day I did not learn something new.
Yeah.
And often it's before noon. And my team will even say, my marketing manager, if something comes up and I say, wow, I didn't know that before. And Jennifer will say, and it's not even noon yet, Tom. So they know how much I love that.
Right.
Learning new things.
Well, and the whole learning process it's about learning opportunities. It's about learning what is possible. But just as important to that is learning what not to do. Mm-hmm. And that's where the experience that you have, your 30 plus years of experience, or the experience I have, just all those things that we've gone through where we can share and help people avoid making some of those same mistakes.
Isn't it a strange irony that most people, I think, tend to retain more knowledge, experience about things that failed than things that were successful. Mm-hmm. I guess that's part of our survival instinct.
Yeah.
But it's, and I tell people when they have a failure, and you will, if you haven't yet, that make sure you don't run away from that and hide, which is the tendency. It's like, oh boy, I don't want anything to do with that anymore. So I encourage people to really, get past the immediate emotion of it, and then go back and dive into it, and go figure out what it is, what didn't work, and what do I learn from this, so that then you can take that new knowledge with you to maximize your success for the next one.
Absolutely.
So as time goes on, you can keep getting a higher and higher success record if you do the same thing. But of course, what happens for folks like you and me is we keep expanding, right? We're doing bigger deals, selecting different asset classes. And I tell folks that I think it's really critical that no matter how much experience you have, if you do something new that's in a new market or sub-market or new asset class, make sure that you get advice from or get somebody on your team who's expert in each of those areas. For example, we recently launched a syndication for an assisted living facility in Fairfield, 140 beds, $20 million. We expect to be worth $40 million in 4 to 5 years. And so we have on the team a land expert who has been doing entitlements for 25 years because we got an infill piece of property. We have an architect on the team who's designed 30 assisted living elder care facilities. We have a developer who's developed 6 of them, and we have an operator who's operated 5 of them.
Yeah.
Now, some would say, well, you're diluting your sponsor fees and so forth, which we are. But I would much rather reduce the risk for myself and my clients, because I take managing other people's money very seriously.
Absolutely.
And there are times when maybe I might take a little more risk, but as far as getting as much knowledge and expertise as you can on the team, I can't emphasize that enough. And so some would say, well, isn't assisted living sort of like multifam that you've owned 9 of? Yeah, a little bit, but it's quite different. It's enough different. I want to make sure I'm an expert. So that's I think that's two of my biggest takeaways. I think for others is the how much submarkets vary from each other. People often ask, what is what's the market doing? And I say, well, first of all, the market is thousands of submarkets.
Yes.
Whether it be a different neighborhood, different metro, different price class, different asset class, class A, B, or C, on and on, right? You go, that's a lot. And then number two is do not reinvent the wheel. Surround yourself with people who are experts and get them on your team so that you can reduce your risk.
Yeah, and we talk about that all the time, about creating a team, creating a solid team, knowing that if you don't have all of the expertise or the time or everything that's needed, listeners, it's really important to be able to bring a team together of well-qualified people. Like you said, it may dilute the potential upside, but it certainly reduces risk along the way. So
I've got a great team. There's eight of us, and then we've got a lot of partners around the country. And it's and the team is relatively young, very bright, a lot of knowledge. However, the one thing they haven't done is they haven't lived through 5 cycles like I have. So I haven't jumped out of a plane with a parachute, although my COO has. So, but I imagine that it's a little bit like the difference between jumping out of a plane with a parachute versus reading about it, right? So intellectually, you can know there are cycles that go down and things can get difficult, but it's much better to have somebody on your team who has experienced that. Because again, you feel the pain when a down cycle, and you've learned how to navigate through it and survive, and that has a lot of value. So as my team takes over more and more of the day-to-day operations, my role is to enjoy still being the face of the company, and number two, be the risk manager. So the one that says, are you sure you've checked? You sure this is underwritten so it can ride out the next recession? Because just know that each deal we do will go through another recession, and we just got to make sure it's solid enough to be able to handle that.
Yeah.
Are you confident that enough in this deal that you'd recommend it to family and friends? And if anybody on the team hesitates for 5 seconds, we're out of there. We're on to the next one.
There's far too many good, solid deals out there to get involved with any that are marginal.
It's always another deal.
Absolutely. So if a listener is interested in getting involved with investing alongside or in a syndication or in that process, what advice do you give, and what is the process for an investor to get involved with something like what you're doing, the syndication piece of it? What are the steps, if you could walk us through that?
Well, the first thing they need to do is to establish a relationship with the syndicator that they're interested in. Well, the first thing to do is to look at different syndicators and figure out which ones have a track record, which ones have the integrity, which ones communicate well and easy to get your questions answered. They don't just take your money and disappear. So probably one of the best ways is to get a referral from somebody that's been through the process and is happy. But anyway, once you've made the determination that you'd like to be associated with one or more syndicators, then the next step is to establish a relationship, because most syndications are under the SEC Reg D 506B rules, which say that you can only offer these shares in this company to those that you have a relationship with. So that can simply mean going on the website, signing up for your newsletter. Now you've made that initial contact. So by the time you write a check, if you decide to invest in something, you will have communicated multiple times, and that's good enough. So the SEC, so this is stock. You're buying stock, but it happens to be private stock instead of publicly traded stock. And it's regulated by the SEC, and the SEC is way more ominous and strict than IRS or real estate board. So everybody, should, and we certainly do, take that very seriously, because we want to keep not only ourselves out of trouble, but keep our clients out of trouble too. So once you've signed up and established a relationship, then that syndicator will let you know when they have a new offering. We have one typically every 6 weeks.
Mm-hmm.
And usually most of them are in the office, industrial, retail, usually neighborhood service center, and occasionally a multifamily if we can find one that has exceptional returns compared to what most of them have.
Mm-hmm.
So in most of the markets we're in, most of it's in the southern Sun Belt of the U.S. We do some development in California, but in the Sun Belt, we're typically seeing 8% or higher annual returns and 15% IRRs upon exit. Whereas a multifam, for example, in San Francisco Bay Area now is typically 3 to 4.
Yeah.
3 to 4.
Right.
So, and so what does that mean? People are gambling on appreciation.
Mm-hmm.
Well, I got to believe that in the hot bubble cities now that we got to be getting, pretty close.
Mm-hmm.
My friend, Dr. Doug Duncan, chief economist of Fannie Mae, predicts that we'll hit a peak toward the end of next year.
Mm-hmm.
Again, the market's thousands of submarkets, then you got to go figure all that out.
Mm-hmm. Mm-hmm.
So once you got a relationship with a syndicator, then the next step is when a deal comes out, if it looks of interest, then you ask for a private placement memorandum.
Mm-hmm.
So the private placement memorandum is the SEC vehicle document.
And that's specific to that particular deal.
Specific to that particular deal.
Mm-hmm.
So we're considered a boutique syndicator,
Mm-hmm.
where the investors get to decide which deals they want to invest in, and they can decide they like this one, but they don't like this metro, and they don't like that asset class, but I like this, and they can pick and choose and build up their own personal portfolio, mutual fund, if you will, of deals that they like.
Mm-hmm.
And a good syndicator will provide an extensive private placement memorandum, which has a tremendous amount of data in it.
Mm-hmm.
People ask about, well, I don't know, how do you think the risk is compared to, say, buying stock? Well, most people who invest with us know a huge amount more about what they're investing in than they ever did in any stock they invested in.
Yes.
Right?
Yes.
Because it's complete if it's a good one. It's and ours are typically 120 pages, and half of that will be solid market information and the rent roll and all of the financials and how we derived and at the projected returns and what the assumptions were that we made and what the occupancy is in that market and what the sales comps are for that kind of product in that market and what the condition of the building is and all of that. So it's there's a lot more due diligence in a commercial property by a good syndicator or buyer than you ever get in, say, a rental house.
Mm-hmm. And do investors need to be accredited for some and not for others, or how is your process set up?
Most, I'd say 80% of what we offer, they can be accredited or not accredited, which the SEC refers to as sophisticated, as you know. And but we occasionally do a 506C, which means you can have general solicitation. In that case, it's just accredited. But most of our deals are both accredited and non-accredited, and the minimum amount is generally $50,000 per share. So what we do is we find a property, and we set up a new corporation that's unique to just that property. And so the investors own that company that owns the real estate. So they own shares in that company, that LLC. And then that company is managed by a management LLC, which consists of the sponsors who found the deal and are putting the deal together and making it happen.
Yeah, and maintaining it, kind of following it through the entire process.
Absolutely.
Yeah.
Yep.
Okay.
So from a structure standpoint, it's really pretty simple.
And do you generally set it up with cash flow, like monthly cash flow, quarterly cash flow, or is it more of a longer term exit strategy or does it really just vary?
They're all the stabilized or near stabilized products are quarterly cash flows. So they're distributing the cash flow from these 8 to 10% annual cash flow deals. These are, we'll get into triple net in a moment, but the if it's a development project or a project that is we got as a bargain because it's distressed, then typically there's no cash flow, or maybe it's delayed cash flow until that value add is there, or until the product has been entitled and built. So we do about 20% deals that are land development and entitlement and construction, or have a significant value add, and about 80% are stabilized and cash flow from the beginning.
And from an exit perspective, an investor invests, what is the time commitment on a typical project? Or do you offer some that are shorter term, where they might be a repositioning or an upgrading of a property, and then it's an exit, and while others are longer term cash flow plays?
All that we have provided are, and we're on about to launch number 19. And we have the length of time is varied from 3 to 10 years. However, I'd say 80% of them are 5 to 7 year time periods.
Okay.
And we always get a loan that's, if we possibly can, that's longer term than what our planned exit is. So we don't have a gun to our head when that time is up if the market isn't good and we want to stretch it out, and if it's in the best interest of the investors, or if it is overperformed, which we have products which are overperforming, and we put on the market early. And if we can return the same amount that we had projected in a less period of time, then that's a win for everybody.
Yeah, right.
So that happens too.
And what happens if an investor invests in a project that's scheduled or projected to go out 5 years, let's say, and something happens in a year and a half where they have some financial challenges or something where they need to pull money out? Is there an exit option, or are they able to sell their position, or what would that look like?
The SEC makes us say that it's illiquid, because there is no ready public market for these for any syndication. However, if someone needs to get out, they can certainly find a buyer on their own, as long as management approves it, which we would. And in the past, when there has been someone that has needed to get out for hardship or the death of a spouse or something like that, we've generally been able to assist them, and we would offer it to the other investors to see if they'd like to get in. So, I think someone should get into a syndication with the expectation that they need to ride it out. Although I'm shocked to hear that from some clients that they've invested before in syndications that had no planned exit. It's like, are you kidding me? It's the first thing you should, not the first, but certainly one of the key things you should do is make sure that there's a planned exit period of time. So at least you have a target as to when you get your money back, right?
Right, for sure.
So we kind of, we're glad to assist with that if somebody needs to get out, but they should get into a syndication with the expectation, treat it almost more like a bond.
Yeah. Okay. And you brought up triple net just a minute ago. Could you describe that and why you prefer working with triple net type of structures?
So triple net means that the tenant or tenants pay the taxes and the insurance and the maintenance on the building. So of course, that gets reflected in a rent, which is lower than it would be if that weren't the case. So what's the advantage to the investor, to the owner, and to the syndicator? The advantage is that it makes it more predictable. You don't have to pad the taxes and insurance because you don't know what it's going to be long term. You can you get to pass that fee directly on, those fees directly on to the tenant. So for the investor, it makes the returns more predictable. And for usually for a single tenant property, it's referred to as absolute triple net, which means that not only does the tenant pay it, but the landlord doesn't even get the bills. So the tax bill, insurance bill, and all the structural cost, the tenant totally takes care of themselves, so you don't even see it.
Mm.
So I would say in general, it takes a higher skill level to manage a commercial property.
Mm-hmm.
However, it's easier if you have those skills.
Yeah.
So I mean, we're dealing with contracts that are 50, sometimes 100 pages thick. You don't get skips.
Mm-hmm.
You don't find tenants walking out overnight like you do with
Yeah.
rental houses. You don't get skips. About the only time you lose a tenant is if they go bankrupt.
Mm-hmm.
In a single tenant.
Mm-hmm.
So what do we do on a single tenant deal? We have expert financial people who are been CFOs in large companies, and they do deep dives to research not only how the company's doing, they look at the principal's financials to see if they have any problem that might roll over into the tenancy.
The principals, meaning the principals in the
tenant.
Yeah, of the tenant.
Yeah. So that's the main risk
Mm-hmm.
there.
Mm-hmm.
So what's the negative for commercial property? The negative is probably if you do lose a large tenant, it can take a long while
Mm-hmm.
to backfill that.
Mm-hmm.
However, if you have multi-tenant, like right now, we're about to close on a 103 tenant industrial deal in Houston, and it is with those are 3 to 5 year leases.
Mm-hmm.
So you get higher quality tenants than you do, say, residential. You get longer term leases. And but unlike single tenant, a single tenant is typically 15 years.
Mm-hmm.
So if your hold period is 5 to 7 and you've checked them out financially very, very carefully, you get pretty low risk. But on multi-tenant, you've got this rollover, just like you do in a multifam or residential property, but you know when that is, so you can anticipate it. So they're not gonna disappear on you. You know that in 1 year this is coming up. So with residential, usually a month or two before their lease expires, then you go to renew that lease. Well, with a commercial tenant, you're usually starting that process a year ahead of time.
Yeah.
So if they're not going to renew when their lease is up, you usually know ahead of time and you can start advertising for that.
Mm-hmm.
So you're rolling that over. And so if they do leave, what's the advantage of that? You can raise the rent up for the next tenant to the market level. So usually the market rent is a little bit higher than what the built-in lease bumps are, as we call them.
Got it.
So usually in a lease for a commercial tenant, you've got annual increases that are built into that lease, and then they're usually options, 1 or 2 5-year say options, so that once that lease period is up, they can renew it. Those prices are already established and preset. So the advantage of the syndicator is you don't have to look for a new tenant.
Mm-hmm. Got it. And self-directed, I'm sure you get a lot of people that have self-directed funds that invest.
About a third of all investors are using self-directed IRA money.
Mm-hmm.
Of course, the advantage is, during the distribution period, it's not much difference. You already have the tax advantage of the depreciation. Commercial property is depreciation, just like you do in residential. And and that depreciation generally pretty much offsets the income.
Mm-hmm.
So what you get is a K1, which you just hand over for each property that you've invested in a syndication, and you or your preparer just puts that K1 data in your tax return, and that already reflects the tax advantages.
Mm-hmm.
The problem with the fact is that upon exit of the syndication, if you've invested from without being in an IRA, then you do have capital gains. It's long-term capital gains instead of short-term, which is advantageous. But you do have capital gains. If you're in a self-directed IRA, there are no capital gains.
Mm-hmm. Got it.
So then you can, and then also, because these are shares of a corporation as opposed to real property itself, a 1031 exchange does not apply. However, there are other tax techniques, which one of our clients just use very successfully to move money from one investment to another without paying capital gains tax.
Yeah.
So there are ways to do that. And if someone is considering, someone has a real estate property now, and they'd like to take some of that money off the table and take advantage of that equity that's built up, especially if that product is in a high-end area like San Francisco Bay Area,
Mm-hmm.
then you can sell that property and use one of these other tax techniques to move that money from that piece of real estate into securities of a company that owns real estate.
Mm-hmm.
So don't just assume that if you don't go from real estate to real estate that you got to pay capital gains.
Got it. And diversification is always important in investing. And how do you, one of the advantages of what you offer, we offer the same, but it's being able to, like for instance, your minimum $50,000 investment, instead of investing everything into one deal, they have the opportunity to invest in multiple real estate projects.
We have a lot of clients who have a net worth that could allow them to buy a whole $5 million property.
Mm-hmm.
However, they like this for a number of reasons. One, it allows for the diversification.
Mm-hmm.
You can distribute your risk by investing in, we have clients, they'll put $50K in this, they'll put $250,000 into this one, $100K into this one,
Mm-hmm.
and they distribute that risk into different markets, different asset classes. Number two, it's totally passive. Once they've made a decision, I like this deal, I like this syndicator, I like this market, written their check, then it's just mailbox money from that point on.
Yeah.
And then, and the other thing is that there's no liability. So when you're a
Mm-hmm.
passive investor, there's no liability.
Yeah. Got it. Now,
Excuse me.
If our listeners would like to get a hold of you, if they have questions, if they want to reach out to you, are you available for contact?
Of course, and our team. We have an amazing team of experts who know some of the details,
Mm-hmm.
a lot of the details now, better than I do.
Mm-hmm.
I'm kind of the aerial view guy,
Mm-hmm.
but I'm glad to meet with anybody or talk to anyone. And the best way to contact us is info@tomwilsonproperties.com.
Okay.
Info at tomwilsonproperties.com, or you can go on the look up tomwilsonproperties.com on the internet, or type in Wilson Investment Properties,
Mm-hmm.
and that will pull it up.
And someone will reach out at that point.
Indeed, we'll be very responsive, usually the same day,
Mm-hmm.
or on there will be our contact. You can call our office, and it's and there's a lot of education information on the website. There's our 5.5 years of broadcast and podcast that's also on iTunes and YouTube, and you can look by subject or by speaker and pull those up. Extensive FAQ on the website about commercial properties. You can go look at our track record so that you can see what are the different kinds of products that you can invest in, what kinds of returns do they get, and we always welcome questions and feedback.
Great.
So tomwilsonproperties.com, email info@tomwilsonproperties.com.
And we'll put that in the show notes as well. So if anybody's driving while they're listening to this,
Okay.
they'll have it in the show notes.
And you also on there, it will show our list of our speaking events and different places that we will be.
Yeah.
So they can connect.
Speaking of speaking events,
Yes.
you were at, this was probably about 1.5 years ago that you spoke at one of my
Mhm.
Bay Area private money for real estate investors meetups. And I'm happy to say that you're scheduled now. We're having you again as a guest this coming Tuesday. And this is, what day? We're on July 2nd right now, 2018.
Mhm.
And next week, Tuesday, is when you'll be speaking at our event again.
Looking forward to it. I always love interfacing with a live audience.
Yeah. No, we get some really good responses. People really appreciate all the information. And
thank you. And as time is going on, I tend to. It's hard for an engineer to shrink the data that you give, but I've been reducing that so that I leave a little bit more time for Q&A at the end, because I think that's the part I enjoy the most is being able to answer people's questions. And again, I always learn something from the audience.
Absolutely. No, that's great.
And in an area like we're in, and an audience like that you bring, very, very educated, very smart people, and it's always a treat to interface.
And I really appreciate you taking the time to do it. I know you're extremely busy and all, so thank you. So if you were to share one key point that you would like listeners to walk away with, to really understand, what would you share as we close out this interview? What would you share as really one of the more, maybe a key point that you'd like to the audience to be able to walk away with?
I think it would be that what worked well yesterday maybe isn't what's best today. And sometimes people ask me what's contributed the most to my success. And one I'd say is by surrounding myself with really smart people who are smarter than I am, and I get to learn from, and they get to help make projects successful. And I'd say the other one is by changing. Just because something worked before doesn't mean necessarily it's the best today. I went from houses in California to houses out of state to multifam, now commercial, syndications, development. So go where the money is. Go invest where it makes sense, not just because you live there. Live where you want to live and invest where it really makes sense. And just like in the 80s when healthy foods became more popular, a lot of steakhouses went out of business. But Sizzler added a salad bar and offered some chicken and fish, and they stayed in business. So you gotta move your model.
Yeah.
So do I not like multifam anymore? No, I like multifam. Yes, everybody has to live somewhere. But why do they live where they live? It's because of the commercial infrastructure that's around it, right? The commercial infrastructure is where they work, go to school, they shop, all of that. Yeah. So move your money and your investing to what makes more sense, and don't reinvent the wheel. You really can invest in these products that institutions and large investors are investing in by riding on the coattails of someone like a syndicator who gives you access to these kinds of products, and you can reduce your liability and be more passive. And I'm pleasantly surprised how many people now, if they've been investors for a while, they're more and more interested now in being less involved, being more passive, so they can attend to their business, they can travel, whatever they want to do. And the key is to really vet and feel very comfortable with the syndicator. And most people who invest with us, you ask them, so why did you invest with this product? Was it because of the asset class or the metro that it was in? And you generally say, well, frankly, it was because we trust you. Mm-hmm. And yes, we like the others too, but that we trust you. So that's, of course, that's the key. People still do business with people, right? And still trust people. Yeah. So I think, so take advantage of others who are in the business and have the expertise, ride on their coattails, use a syndicator, and go move your investments to things that are having higher returns now. And this day and age in real estate, commercial, non-multifam commercial in heartland of America cities is where the best returns are. Mm-hmm. And I'd say I feel the lowest risk as well.
Yeah. Less less susceptible to all the market changes. Great.
Dallas, Texas is where we've do most of our half our investing. The other half is in other cities, and California for development because of the heavy lift because of the difficulty in getting those done. And for example, that was a good decision when I made that move down there. It's in the crash. Dallas Fort Worth dropped the least of any metro in the United States, 7.7%.
Mhm.
So the homework really pays off, and the homework of your syndicator that you're with, by not only evaluating and finding things that have good returns, but also products and markets that have less likelihood of dropping. It's like the old adage is that that Buffett has made popular. Make sure you keep the money that you got.
Yeah, exactly.
Tom, it's been great being on the
Yes.
program.
Thank you very
for
much,
having
Tom, for joining us, and we look forward to seeing you again soon.
Thank you.
Thank you.